Per usual, loading on this channel is for educational purposes only and is not intended as financial advice. It is Macro Monday on this Memorial Day. U.S. markets are closed. Crypto markets, of course, 24/7. We don't have a James Butterfield report yet for the week, but we do know, thanks to the far side data, that we have had 2 weeks of consecutive billion-dollar inflows, the largest set of inflows for Bitcoin in quite some time, largely because GBTC has stopped selling. So that's always a good sign. Looking at the weekly data makes it perhaps a little bit more clear what's going on here. And this is all good news. We don't need 10 billion a week. We just need a constant stream of bidding from anybody in any of the products. And we should continue to do fine here. Supply down, demand up, price up. That's pretty much it. We've got Gox coins, we've got FTX stuff, we've got Celsius, BlockFi. We've got lots of potential minor speed bumps coming up, but I don't think anything is going to be super important. I think the next big thing is going to be the ETH outflows when the ETH ETFs go live, and we likely see a pause in the ETH price at the very least at that time. But that is probably weeks to months away from now. Looking at the Bold report, 30-day cumulative flows, we are back to positive on the cumulative flows. So again, it's hard to just be bearish when you see stuff like this. We aren't raging month over month like we were in 2020. We aren't spiking hard like we were when the ETFs first launched. But again, we just need a little bit of inflows consistently, and we should do just fine price-wise. Contrasting that with gold. Gold has seen a divergence here in that prices continue to move up while flows are coming out of ETFs. This could be central banks globally, it could be China, it could be India, it could be retail, it could be a combination of everything, but it's not coming from these ETFs. You're not seeing 30-day cumulative flows positive at all. We'll take a look at gold and commodities further, likely taking a pause, a breather here in that rally. And we also had this hit the wires today a few minutes ago, Vanguard announcing some sort of fund for something digital asset related. And look, we'll take it. Again, it doesn't matter who it is. It doesn't matter what it is. More is better. They could say, well, we don't want chip coins. We don't want an ETF. I'm right there with you. I don't think we need an ETH ETF, but we'll take Schwab ETFs. We'll take Vanguard stepping into ETFs. Whatever. We'll take it. We will take it. Before I go any further here, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with the link in the description of this video. Non-investment advice, crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Payward Ventures, Inc., PVI, DBA, Kraken. Looking at the charts today, meme coins continue to do quite well. Pepe, Floki, regardless of whether or not they're listed on Kraken Pro for you in your jurisdiction. WIF also doing very well, turning up. SHIB turning up. Is that a sign of the times? Is this late stage? It certainly doesn't feel like late stage. Across the board, especially looking at commodities, it feels like everything's essentially in some sort of cup and handle formation at this point. Or we're taking a pause in a rally in a copper example, which I'll get to. But things certainly don't look bearish. It's hard to find bearish charts in the leaders. Most of the leaders here look quite strong across the board. Crypto, legacy, commodities. And that's aided by a falling DXY. Trueflation here is a bit problematic. Certainly not what Fed Nowcast is showing. And it's problematic because the month-over-month number for May has basically gone straight up since the beginning of May. Now, if we look at the Nowcast has us at 337 for May, despite printing 3.4 last month. So either Trueflation doesn't match CPI, which is possible, or the Nowcast is misrepresenting potentially a jump in the next inflation print. Definitely something to be mindful of a little bit. If there's anything that can get markets angry, it's inflation picking up again. The threat of hikes instead of cuts, that sort of thing. This whole structure, by the way, we will see. I certainly hope not. I certainly hope this is not an inverted head and shoulders, but that's what it looks like. If we zoom in a little bit, you can see the May data a little better. March to April was up. What is this? Yeah, April was right here. So April to May was down as far as directionally, but since then it's been back up once again. Definitely not something we want to see. We do have a PCE print on Friday. I talked about that yesterday. I don't think that's going to help us or hurt us. It's just basically flat for the past couple months now and definitely above the Fed's target. Maybe core is headed in the right direction. And I don't think I've ever seen a disparity in the types of people calling for cuts versus hikes, which I'll get to in a second. But even Urian Timmer is saying, well, okay, is this a reinflation trade? Is this a weaker dollar? Is there going to be a monetary pivot? He goes through what that might look like for the 2-year for DXY coming down. Again, this is what we want for crypto. When I hear EM strength, that means weak dollar crypto strength. So we'll take it. Doesn't necessarily mean we're going to enjoy IRL meat space stuff if we get a reinflation everywhere picking up again. And here's the commodities cycle. He was highlighting 2016, 2020, potentially picking up again now in 2024. This is the Bloomberg Commodity Spot Index. And the commodity charts certainly look bullish. Not just orange juice and cocoa, but the metals and energy. We also saw a very large increase in allocation from those surveyed from Bank of America. Very similar to, again, March 16, June 2020. So it makes sense that we are seeing money flow in. The question is this crowded already? Is it over? Is it going to be a multi-year cycle? Is this all being fueled by AI expectations and industrial build-outs and the need for copper and nuclear energy and electricity, right? I think that remains to be seen. I think it's likely we will see a demand that outpaces supply. And again, we have rising prices, but we'll see. Charts certainly look like they want to go higher. Looking at meeting probabilities, next meeting not until June 12th. Not going to see a cut or hike on that meeting. Unlikely to see a cut or hike in July either, but depends what Powell has to say. And then I guess we'll see what the labor data has to tell us for the remainder, but I doubt much is going to change between June and July to change Powell's mind there. We can check. So this week, there really isn't any big numbers except PCE. Next week is employment data, unemployment rate, ISM, which maybe affects risk positioning a little bit. But really, it's going to be the unemployment rate and the PCE number on Friday. Those are the big two things in the next 2 weeks. We still have the major banks mostly calling for cuts. Mostly. Some think as much as 100 basis points. I doubt we see that. I think 1 to 2 cuts are possible, but you could tell me on any given day we should see cuts, we should see hikes. Depending on who you are in the ecosystem, you're going to have the CIO of BlackRock telling you that on the good side, we've done as much as we can with rates. On the services side, the Fed can't really alter that with rates. So what's the point? It's basically what he's arguing. Now, most people are just talking their book and they're saying, we want rates down because that benefits us. You know, if you're fixed income, you want rates down. If you're commercial real estate, you want rates down. But sure, you know, this line of argument, I'll leave it in the comments, makes sense, but I don't think it's enough to cut rates. I think ultimately it's going to take a break in the labor market for rates to come down. As far as liquidity is concerned, reverse repo still flat, hasn't really changed much over the past couple months now. We're not really seeing reverse repo liquidity injections. We're seeing potentially liquidity injections in other ways, this being a treasury buyback schedule. It is small. It is super small. Alex talking about what it is and what this means, but it's a representation of changing previous behaviors. We'll say it like that, right? You know, we're tapering QT, we're adjusting the yield curve. We're doing all these things maybe a little bit around the edges to get through this painful period. But isn't that the point? Isn't that the point to be restrictive, have the pain, have a bit of a reset, and then bring rates down? So while this is not exactly QE, it does add liquidity into the ecosystem. Look at the yield curve in the darker green here. We We still have the front end slowly ticking down. 3 month to 1 year, maybe all the way out to the 2 year, slightly picking up here. Belly of the curve still not doing much. And then the long end also just not doing much yet. Now there'll be a point sometime within the next 2 years where I can point to this chart and say, aha, this was the moment, right? I know not much has really happened in the short end, but once the Fed starts cutting or hiking, this is going to look a lot different. And that's going to affect things on the risk side pretty dramatically. Here's the 10-year yield with the cloud. It favors weakness in that we likely get a bearish TK cross here on the 10-year yield. We certainly don't want to see a 10-year yield above 5%. That's when things get interesting. So a ranging 10-year is good. A falling 10-year is great. And a 10-year below 4%, if that ever happens again, would be amazing. But we're issuing so much debt and we have less buyers. It's going to be hard to keep this down for an extended period of time. As far as the 10-2 curve, we're actually getting more negative on this, which means we're re-inverting. We're not uninverting. We're not uninverted. We are re-inverting. So all of these people continually calling for a recession. We're already in recession. These numbers don't represent reality because of blah, blah, blah reason. Okay, that's fine. But, you got to give me something to go off of. And historically, this has worked. So what you're trying to tell me is this time is different. Even if we go to the 10-3 curve, dating back since 1982, still very negative, still inverted. So we have time. Now, the moment we start to invert on this, or uninvert on this, you could say the Fed is cutting from weakness, unemployment is rising, yada, 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 all that stuff. We're not there yet. We're just not there yet. So I think that's why we're seeing this reinvigoration in risk. That's why we're seeing what feels like loosening monetary policy rather than restrictive monetary policy. GDP still in the 3 to 4 range. Definitely not recessionary. Definitely not recessionary. So again, you could say, well, it's because we're spending so much. Okay, but we are spending so much as a government, as a country. So what's your point, right? Like, yes, this may end up in a recession. We may spend more post-recession when it happens. During the recession, okay, this is not going to be declared a recession based on these numbers. It just isn't. Looking at DXY, similar to the 10-year yield, it's sort of flirting with a bearish TK cross. Going back into the daily cloud, this is what we want to see. We want the groundhog to see the shadow, and infinite months of winter for the DXY, potentially remotely head and shoulders on this. Doesn't really matter, but maybe something to watch for. Down the road, if this can crack 104 to 103 or less, or get below the cloud, I mean, that is just easy moves higher on everything. I think the reason we're having this pause in general is because we saw some mild strength come back on the DXY. But if we can see dollar strength wane significantly for whatever reason, is it jobs, is it PCE, is it the Fed coming out and saying we're cutting in September or whatever it is, we'll take it, doesn't matter what. But we're not quite there yet. We're still in this middling period, definitely in the multi-year range. We've also got UJ, which the TA target on this pair is much, much higher. The fundamentals of why UJ is weakening, why the dollar is strengthening against UJ, aren't changing anytime super soon. Rates here are higher than in Japan, so effectively they're short JPY, long USD, and that's why we're seeing this continue to rise. But again, you have a bearish TK cross coming up here. So the less this strengthens, the lower the risk of yields rising from Japan selling US treasuries to shore up UJ with an intervention policy. It's kind of a complex domino of stuff going on there. But just know we do not want to see UJ going higher, even though it will probably go higher. I think most importantly is we don't want to see a runaway UJ parabolic move. I think it can continue to weaken slowly, but when it spikes super quickly, that's when people get nervous. So at this rate, it's probably okay. Obviously awful if you're in Japan, seeing your savings being devalued continuously. That's why if anyone needs BTC, it's Japanese savers. We also have the euro in the candlestick chart in the back there. Euro is essentially the opposite of the DXY, so to see euro strength would be bullish for BTC. If we look at BTC versus the euro since 2021, pre-ETF, it was basically in lockstep. So once again, if we're seeing euro strength, DXY weakness, that should be bullish for BTC. Weak dollar should be bullish for BTC. So if you have a viewpoint there, express that viewpoint accordingly. We also have, zooming way out on the euro, I don't know on what planet or for what reason the euro would strengthen significantly against the dollar. But let's say we see that like we have semi-cyclically, then I gotta think Bitcoin does extremely well in that environment. Even altcoins do very well in that environment. And you've got all sorts of people already calling for various shades of this, not necessarily because we're seeing euro strength, but maybe the dollar does weaken significantly to allow something like this to happen. I mean, that would be 6-figure BTC plus and then some. Gold kind of taking a pause here. I think all the commodities pulled back last week pretty hard. They're still above the daily cloud, still working on its head and shoulders target, still working on its falling wedge target. It looks fine. It's not exciting to me. I think there's better stuff to trade, but it looks fine. And I said yesterday, gold is actually up more on the year than the S&P, which is kind of bizarre. Maybe that's something to go back and look at. When has that happened and what has happened after we've seen that? But gold obviously still on a tear. Silver also doing quite well coming out of its multi-year inverted head and shoulders, potential cup and handle formation, potential like coffee and markup. Like there's a lot of stuff this represents. None of it is bearish. It just isn't. Expect a consolidation and or continuation. Expect this to hold the neckline. This looks very bullish to me. Doesn't go there in a straight line, but 50 would make sense eventually. Lots of talk of the gold silver ratio. I don't really see a signal here. Maybe you could say, well, it's bottoming and it's at a historic low. I don't know, I guess. But it's certainly turning up and strengthening against gold after being pretty undervalued relatively, dating back since, 1945. Almost 100 years of the gold-silver ratio. Gold and silver miners look fine to me still. This is WPM coming off a multi-year inverted head and shoulders. This stuff moves slow. I have a position in this. I'm not really worried about it. The commodity stuff for me is just set it and forget it. You have some, take profits from BTC maybe and buy Commods when it makes sense. But these look good. These look very good collectively, including copper. Copper obviously had a crazy run or has had a crazy run since the beginning of the year. Pretty nasty pullback last week. My guess is this tries to consolidate up here for some period of time, 3 months, 6 months, I don't know, and then continues. But this does not look bearish to me. It's certainly very overbought, and you had a lot of hot ball of money type folks come in and buy this. The moving averages need to catch up a little bit, but before that you had ascending triangle, Adam and Eve, inverted head and shoulders. There's tons of stuff pointing to higher. Just on the CFDs for copper chart, copper miners still look great to me, similar to WPM, kind of the same chart. No issues there. Where all these break down is if you make new lows. So 35 would be problematic. Copper has copper would have to go back to like 365. WPM would have to go back to 39. Until then, there's really nothing to say here. Silver would have to go all the way back to sub 22, and momentum is definitely up in the near term. Uranium also looks very good, coming off of its multi-year bear trend post-COVID, and now after a multi-year consolidation. This to me looks like a cup and handle, looks ready to go on the weekly, also looks good. So no real threat of any bearish reversals here from a macro standpoint. Even platinum and palladium, zooming way out, it's been in a downtrend since 2021, trying to bottom here. I'm probably still very early on this, but it looks good enough, right? Why not? Why not give it a shot? It's in the weekly cloud, or sorry, the 3-day cloud. Stop loss on something like this would be any lower lows, 920, something down there. As long as we're making higher lows, totally fine. No issues whatsoever. Then we've got oil, which is a little different than the rest of the Commods package, more energy. We've got Biden releasing barrels from the SPR again, which, love it or hate it, he can do that. So he's doing it. Oil itself is still stuck in a range, looks more bearish than bullish. Doesn't look like it's headed significantly lower. But I would think if we break 74, potentially we see bearish continuation. Now, if, let's for instance say we enter a global recession like many think we will, then that's possibly how this chart actually plays out. That's possibly how this ends up being head and shoulders if we start to price in, demand going to zero or whatever. And not as bad as COVID, but some sort of global recession, right? I think that's how we get oil sub 70. But so far, just ranging. Looking at US gas prices, year over year, not really much change. Month over month coming down. Slightly, not much change overall, but certainly not raging like it had been in 2022. Even in 2021, it just was a slow tick of death month over month. Higher, higher, higher. So it'll be interesting what happens for the next administration, whether that be Biden or Trump. Does Trump open up the mining permits on gas and we just start pumping more oil? Does Biden stop draining the SPR? These are things to think about in the long term. XLE Energy ETF turning down, definitely the most bearish chart we've looked at probably so far. I think it's still fine in the ascending triangle. You never want to see something come all the way back into a triangle after the breakout. Whether this be head and shoulders or falling wedge, it's probably got a little bit of a journey towards 89. I'm still holding my XLE. I have no issues. With lows, it's pretty much a hedge anyway. If let's say I'm wrong about oil and oil gets expensive again, I'd expect XLE to shoot up as well, and that would mean inflation shoots up, risk down, that sort of thing. But certainly less bullish than it had been. It was coming off, I think, 18 weeks straight of bullishness, and we may see something like this for copper as well, right? A consolidation for copper could be a falling wedge, it could be an ascending triangle, it could be a bunch of stuff that eventually leads to continuation, but it's way too early to tell what's going on there. Looking at the S&P, we are the most bullish we've been since 1952 in election years. Certainly doesn't feel like a recession. Anytime you hear someone saying we're in a recession, just ask them, well, asset prices are looking pretty good, and then they'll say the S&P is not Main Street. That's fine, and that's true. But our definition of recession and what that means hasn't come to fruition yet. So we look very good on the election years. On the daily cloud, we look fine. Bullish, cup and handle, maybe. Maybe this gets angry and retests 51.50, but does not carry a bearish expectation whatsoever. You're going to get people screaming about a double top if this pulls down and doesn't continue. You're going to get people antsy at 5,200 if we don't see new higher highs, but all crypto needs is just flat or up on the S&P. Ranging is fine. Let this range for the next 3 to 6 months. It doesn't matter. Crypto will do fine with that. So that looks very bullish to me. I think the bigger issue is relative to halving for Bitcoin. Most of the halvings, at least the previous 3, have been coming off of a recovery in the market in the S&P. I would argue this halving, we are actually the most fully in a bullish rally that we've been ever for BTC. Now, there are some people that think we're just going to continue this everything bubble S&P to infinity. Bitcoin will do fine in that environment. But if the S&P stalls, lags, or turns down, it's going to be interesting what sort of yin-yang we're going to see relative to Bitcoin price. If the S&P does turn down, it probably means that we see a stronger dollar, less liquidity, and I don't think anybody's expecting that whatsoever. Possible. It's always possible, right? It's always possible we hike rates, we get inflation ticking up again. Just depends who you ask on any given day, because you could have evidence for either side of that argument. But it's definitely something to watch for over the next 3 to 6 months, and that's why everybody's still so keyed in on the economic data. Qs look fine, same story. Look bullish. Cloud loves it. A little bit overbought, certainly. I think it's going to take time for the moving averages to catch up, the TK lines to catch up, just like it did in November into December. But it looks fine. Looks totally fine. IWM, on the other hand, bullish on trend based on the cloud, but it does have a pretty nasty potential head and shoulders here. And if for a second there is a reinflation expectation or a rate hike expectation, you got to think the IWM takes a spill lower, and this plays out as a head and shoulders. So I don't think IWM is the place to be. As far as the individual names, crypto related, MSTR still looks plenty bullish. I just question how much more bull is in this thing. How much more NAV premium are we going to see? The Turbo Ultra Uber MSTR bulls think we're going to see like 10x NAV premium or something ridiculous. Sure, possible. I think that's unlikely, but it's possible. Definitely bullish on trend, definitely bullish recovery. Looks great on the daily, no doubt. I just think it's moving a little too fast for where it should be priced. Coin looks great. You know, this is a different story, probably for MSTR as well. A different story for Coin if the ETH ETFs get denied. That certainly helped the coin price. It certainly helped the falling wedge play out. Back above the cloud here on Coin. Coin looks great from that perspective on technicals. And it just looks ready for another wave of up movement here. This could be interpreted as a rounded bottom or an inverted head and shoulders or something messy, just like it was in January, February. But we're getting a 4-hour breakout once again on the chart here. So it doesn't mean you're going to see another 2x move here. It just is letting you know we are bullish again, and you have some sort of chart pattern there on your side. So that looks very good. Hood looks excellent in Wyckofian markup after a multi-year Wyckofian accumulation-ish above the weekly cloud. I have nothing negative to say about this whatsoever. Call this a mega turbo cup and handle. I like 40 plus for Hood eventually. Call this a cup and handle on low time frames. Again, the 4 hour is on your side. It looks very good. It looks very good. Bullish expectations, definitely. And it's no coincidence to me that BNB, as I plug my position, filled before shill. Just remember that. It's no coincidence that BNB to me also looks decent. It is an exchange after all. So if Coin and Hood turn up, I got to think BNB turns up as well. All three exchanges are very different and have their own issues, but semi-related. Square, on the other hand, does not look so hot down here. It's still in the weekly cloud. I think there's a trade here eventually within the next 3 to 6 months, but we're just better served elsewhere. I think in the near term, trading almost anything else relative to what Square has done here over the past couple weeks. So there is a 2x here, probably, eventually, just not right now. Same thing with PayPal. PayPal's looked better than it does currently on the 3-day. It hasn't looked amazing. It hasn't looked great for a long time. But this is kind of like the Palladium Platinum trade for me. If we are getting into the high time frame cloud for the first time in years, yeah, I'll take a stab. Why not, right? Your upside here is probably a 2x eventually, if not more. Yes, it's PayPal, but chart looks okay. Doesn't look horrifically bad. It looks like it's been through enough pain and could potentially turn up. So your job as the allocator or the trader is just to decide, okay, this is my favorite. This one's my watch list. This one I would never touch, that sort of thing. Looking at WGMI, we are back above the daily cloud. We are above the resistance diagonal. Looks okay. Does it look amazing? No, but this could be the start of something. Going forward here, if Bitcoin moves toward 100K, yeah, I think WGMI might start to lift off. Would I be over allocated to miners relative to BTC? No. Would I be over allocated to miners relative to leveraged BTC? Also no. That's just me. But the cloud is starting to look better for the miner ETF. CleanSpark individually in some sort of trend channel up here looks fine, looks okay, has been ranging basically since the beginning of the year, but it had one heck of a 2023. So no real concerns for imminent bearish reversal there. Marathon just ranging, not really much going on. A lot of miners look like this, where they've kind of been dead money for 6 months here. Just not much going on. Definitely a possibility. Mara has like a 5x in it, but I don't think we're quite there yet. RIOT even worse than Mara. This thing's been ranging angrily for a year at least. And so this to me would be a massive avoid on an individual basis. Gotta wait for something like this to show you that it wants to be bullish first. IREN looks excellent. Just night and day relative to RIOT. It's above the daily cloud. It broke out of the tight triangle consolidation. And it's above some sort of neckline resistance that it had dating back since 2022. So I think something like this could easily 20 to 40, basically IPO listing. No problem. regardless of the fundamentals of any of these miners. I'm just looking at the technicals. And the technicals for IREN are certainly more favorable probably than any other chart here, and that includes WULF, which is my pet favorite. It is below the cloud, below the triangular consolidation. Really hope this does not play out as a head and shoulders here. I'm optimistic. So it looks okay. It looks rough, but it looks okay. It could look worse. Certainly could look better. And I like it more 3+. So this certainly has a 5x plus in it, potentially, if this turns up. So look, there's lots of stuff going on, lots of opportunities. I think the Mag 7 plays are just kind of boring at this point, which is crazy to say. You've got NVIDIA and everything else. Maybe the Mag 1. Definitely going to be careful watching NVIDIA and see what it does here in the next couple weeks. But we're looking okay. Weak dollar is great for us. Yields down is great for us. So anything that feeds that cycle, that momentum, should be bullish for BTC. That's all I got for this one. Like, dislike, comment, share, subscribe, and happy trading.